So supply and demand zones are everywhere in the market. So how do we know then when we need to take a trade from these specific supply or demand zones? Well, we use our market structure as a basis for framing that trade idea, and then we mark on our demand or supply zones within our market structure. Okay? So market structure always comes first, because market structure is the first thing we do when we get to the charts. And then what we do is we draw on our demand or supply zones that we will potentially take buys or sells from. So this is the picture perfect example of the bullish and bearish trend. And in a bullish market, right, we are making higher highs and higher lows. Very simple stuff. Everyone knows that in a bullish market, it's higher highs, higher lows. Okay, everyone's happy with that. In a bearish market, there's lower lows and lower highs being created. Okay, so in a bullish market, right, we want to take longs. Okay, that's our general kind of original trade idea, is that we're bullish and so we want to trade with the trend, and so we want to take longs. Okay, so what we do is we map on our structure, we map on our market structure first, and then what we do is we look for our supply or demand zones within our trading range to then potentially take trades from. So if we've broken structure, right, if we've broken structure here and we've started to pull back and we're here now, we can then map on our weak swing high that we expect to be targeted, right? This is our M15 weak swing high. And we can also map on our M15 strong swing low that we expect to hold, right? This is our M15 strong swing low. This is our impulse leg of the M15, okay? So this is now our trading range. We've impulsed up, we've started to pull back, so our trading range is now within this weak swing high and this strong swing low, okay? So hopefully everyone can grasp that. That's pretty easy. So what we do then when price starts to pull back is we can now map on the demand zones that caused that break of structure to the upside. Okay, so we want to look back at our trading range, that is this impulse leg here, and we want to see, are there any demand zones within this leg that caused that break of structure to the upside? And there's always going to be at least one. Okay, so in this example, prices started pulling back, and the extreme zone is the extreme demand zone that we've mapped on here. Now this will become a bit more clear when we go to the charts, but just take it at face value right now, okay? So this is the extreme demand zone that caused that break of structure to the upside, okay? And we can map that on within our trading range that we know we're trading within. So we've had a break of structure, we're starting to pull back, and we can map on our extreme demand zone that is here. Now, what we expect then is price to come back down into our extreme demand zone to then target this M15 weak swing high. Okay? So just like with market structure, where we expect a break of structure, a pullback to the strong swing low, and then a break of structure again, we expect a break of structure, a pullback to the strong swing low, and we expect it to come into some sort of demand zone that caused the break of structure to the upside to then target that weak swing high up here again. Okay? So then what happens, right? We then react off of this demand zone and we break structure. We break M15 structure to the upside, right? Here's our break of structure. We then start to pull back. What can we now map on? We can map on our strong swing low that we expect to hold. We can map on our weak swing high that we expect to be targeted. And now we have our trading range that we're trading within. We have our swing high that we're trading within and our swing low that we're trading within. So just from a market structure perspective, we expect a break structure, a pullback to around where the strong swing low is, and then to target that weak swing high to the upside. So now overlaying the supply and demand onto market structure, we expect a break of structure, a pullback to the strong swing low into the demand that caused that previous break of structure, into this demand zone, to then take that trade, take that long to the upside to target that weak swing high. Okay, so quite simple stuff here. I think lots of you will probably know this already anyway, but you know, going over it doesn't hurt. So then what do we have in the bearish example? We have a push down, a pullback, and a break of structure to the downside. So purely from a market structure perspective, after a break of structure, we can expect a pullback. Price starts to pull back. We can map on our strong swing high that we expect to hold. We can map on our weak swing low that we expect to be targeted. And then we know that we are trading within this trading range, okay? This is our trading range that we're going to trade within today. So then what we can map on is our supply zone, which caused that break of structure to the downside. And in this case, it's the extreme supply that caused that break of structure to the downside, okay? So what do we expect now from a supply and demand and a market structure perspective? We expect price to pull back into the strong swing high, right? Into the strong swing high that we expect to hold, into an area of value, which is this supply zone, into our POI, point of interest. Then it reacts off this point of interest and targets that weak swing low, okay? So it's just overlaying the supply and demand zones onto market structure. Our market structure perspective is still that we break structure, we pull back to our strong swing high, we break structure, we pull back to our strong swing high, we break structure. All that supply and demand does is tell you where potential areas are that price could come into near this strong swing high to then target that weak swing low, okay? So market structure is still the first thing we look at, the first thing we do. We have market structure going, breaking structure, pulling back to strong structure, targeting weak structure, pulling back to strong structure, targeting weak structure. And the supply and demand zones, the supply zones in the bearish example, right, are always zones that we could potentially see that price reverses from around this strong swing high to target that weak swing low. Okay, so I've done a little 1, 2, 3, 4 on what you should be doing. So you should always map market structure on first to know which trading range we're trading within, our weak swing low and our strong swing high, number 2. Then you map on any relevant supply or demand zones. Here is our relevant supply zone that caused that break of structure to the downside to begin with. And then we can potentially wait for price to come back into our zone, trade from these zones and take them to the downside to target those weak swing lows. Okay, so this is our picture perfect model. However, we all know that it's not like this in reality, right? And so I've drawn on, this is the same diagram from earlier, but I've just overlaid the supply and demand zones on again. So overall then, what do we have in this bullish example? We have a break structure up, a pullback, and a break of structure up. When price then starts to pull back, right, we have our strong swing low that we can mark on because it broke structure to the upside, and we have our weak swing high that we can mark on because it's failed to break any structure and it's likely to be targeted, okay? In a bullish market, we want to get long, so we want to see where we can get long from demand zones, where that demand stepped in to push price higher, okay? So we look back at our leg and we look for a demand zone that was, formed, that broke structure to the upside, that caused that break of structure to the upside. In this case, we've drawn it on at the extreme of the range. So this is a potential area. Remember, it doesn't have to come back to here, and it could go from up here, right? But this is a potential area that if price came into it, I would be happy to go down to the M1, look on my entry model, my entry time frame, right? And potentially take a trade to take out this weak swing high. So what happens in this case? Price comes back, right? It comes into our demand zone at the extreme of the trading range, into our zone that must hold in order for price to stay bullish, and price reacts from it and breaks that swing structure to the upside. Okay, so now once we get this breaker structure, right, we can expect a pullback. Price starts pulling back. Now, in this case, again, we can mark on our strong swing low that broke structure to the upside, and we can mark on our weak swing high that has failed to break any structure to the downside, okay? Now, in this scenario, it isn't as picture perfect as in the models before, and it's not as picture perfect as this one, because we've now got two demand zones in this leg, okay? So what happened was we had a initiation, a push out of this zone here, and that forms a demand zone at the extreme, right? We then have a slight pullback and another push up, which breaks that swing structure to the upside. Now, because this was a pullback and a push up, and this was a pullback and a push up, these are both valid demand zones that we are able to trade from. So as we start pulling back here, okay, we can now look that we're in a bullish market, so we want to take longs. Where did that demand step in that caused this break of structure to the upside? Well, it stepped in at this zone here, which we can draw on, and this zone here that we can draw on. So therefore, we can wait for price. We need to be patient and wait for price to come down into one of these zones to then go down to our entry time frame, our M1 time frame, look for our entry model to then take it higher and target the weak swing high. Okay, so again, it's market structure. This is our swing leg, our break of structure to the upside. The lowest point is our strong swing low, which is here. The highest point is our weak swing high, which we expect to be targeted. Now within this leg, it's not as picture perfect as this one. Within this swing leg, there are now two demand zones that we could potentially take a trade from. So when price comes into either of these demand zones, we can go down to our M1 entry time frame and look for our entry model to get long to target that weak swing high, to target that weak structure. Trade from strong structure, targeting weak structure, okay? Then what do we have? We have this break of structure to the upside. And in this case, again, what happens? Well, the demand that stepped in that broke that structure to the upside, there are two potential demand zones that we can take a trade from, right? This is our strong swing low. If price starts pulling back, this is now our weak swing high. Our trading range that we're trading within is this strong swing low and this weak swing high. And where demand stepped in to break that structure to the upside was here in this demand zone and here at the extreme demand zone. So then we can wait for price to come down into one of these demand zones, look for our entry model to target that weak swing high again. Okay, so supply and demand is just overlaid onto market structure. Market structure should always be the very first thing you look at, the very first thing you map on, and the very first thing that you build a trade idea around. You then look to see where demand stepped into the market that caused that break of structure, and you can then map on that pivot demand zone here and that pivot demand zone here. That then potentially, if price comes back to, we can look to enter to target that weak swing high. So exactly the same for the bearish example, right? We have a push down, a pullback, and a push down, a break of structure. So we start to pull back. Now this is our weak swing high that we expect to be targeted. This is our our weak swing low that we expect to be targeted. This is our strong swing high that we expect to hold. What happens? We can map on our supply zones within this trading range, within this strong swing high and this weak swing low. We can map on those supply zones as potential areas that we could take a trade from to target the weak swing low. Price then comes up into our supply zone at the extreme. We can look for our entry model on the M1, and then price, what does it do? It targets that weak swing low and breaks that swing structure to the downside. Okay. What do we expect after a break structure? We expect a pullback. So this is our break structure leg, and now we've started to pull back. After a break of structure, we can look back and we can find our lower high, our strong swing high that caused that break of structure to the downside. And then this is now our weak swing low that we expect to be targeted, right? So this is the trading range that we're trading within. We're trading within our strong swing high and our weak swing low. We're in a bearish market, so we want to get short. We can then look for where supply stepped into the market that caused that break of structure to the downside. Where did supply step into the market that caused that break of structure to the downside? Well, it was this pivot supply here, and it was this pivot supply at the extreme. So there are two potential areas that we can now wait for price to come back to then target that weak swing structure to the downside, right? So what happens? Price pulls back into this supply zone, so we can look for our entry model from here to target that weak swing low. So we're still trading with our original framework is trading from strong structure to target weak structure. We just look in our impulse leg for where supply steps into the market in order to break that structure to the downside in the first place. We then look for these zones, and these are now potential areas where lots of big institutions have orders here, have sell orders here, that if price comes into this zone, these orders will be triggered, and then we will target this weak swing low to the downside, okay? Because what could happen as well, right? Price could come up, it could react off of this zone, and then it could push up and this zone could fail, right? It could break through this zone. We're still bearish, and we've got one more supply zone that we could potentially take a sell from. Price then could come up into this supply zone, react from it, break internal structure to the downside, and then continue lower and take out that weak swing low down here, okay? So it doesn't have to be from this supply zone here. We map on our market structure and we look for the areas in which supply stepped into the market that potentially we could then take a trade from. And then when price comes into it, we look for our entry model to then target the weak structure to the downside, okay? So I'll go through some examples on the charts now to kind of let you understand exactly what I'm talking about.